Okay, great. Okay, well, welcome everyone. Tonight we have Allie Texter, who is a financial planner with Northwestern Mutual Life Insurance, and she's going to be bringing us some really great information. And I will turn it over to you, Allie.
I love it. Thank you, Monica. I'm going to go ahead, start sharing my screen so everyone can see what's on there. Monica, let me know when you can see it.
Yes, I can see it.
Okay, perfect. So I do have a presentation today, but a lot of what I'm going to be talking about is directly going to be coming out of my mouth rather than on the screen. But like Monica had mentioned, today we really want to talk a little bit more about financial planning, what that looks like with Northwestern Mutual, what that looks like with different kinds of people. There is, of course, a framework that I'll use for a lot of different clients, but it is very much a personalized experience for a lot of different people. So I'm just going to dive in a little bit, give you a little bit of background on myself as well as Northwestern Mutual. So Northwestern Mutual has actually been around since the 1800s, 1857 to be exact. Our home office is out of Milwaukee, Wisconsin, but as you'll see when I go over myself as well, we have about 2 offices specifically in Capital Region area as well as the Hudson Valley area. And I am based out of the Hudson Valley office, actually in Poughkeepsie, New York, but I spend probably about 30% of my time up in Albany as well. So I am super familiar with the area and everything in that regard. But really what Northwestern Mutual and their background is they initially started as a life insurance company. So started as a life insurance company in 1857. It was a group of about 10 men, I believe, where they wanted to make sure that their families would be okay if God forbid something were to happen. So that's really what the background of Northwestern Mutual is built off of, making sure that people that you care about around you are going to be okay financially, God forbid something were to happen. So over the course of time, though, it has turned a lot less into just life insurance and what does life insurance look like for clients. And we've turned into a full service financial planning firm. So along with life insurance, we also specialize in different kinds of insurance as well, whether that's long-term care insurance, disability insurance, making sure that you have the right coverage for you as well. We also focus on retirement planning, education planning. So if you're a young family and want to start saving for college for your children, grandchildren, that sort of thing, we'll also talk about those areas, talk about how to grow your money in regards to investments, and everything in that regard under that huge umbrella that we will continue to dive into as well. But when we're talking about financial strength, Northwestern Mutual is actually #1 in terms of financial strength among financial services companies. And the top 3 rated financial sort of corporations in the United States of America are actually Northwestern Mutual, Microsoft, and the United States government.
Wow.
Yeah, so there's a lot that backs up the work that we're able to do with our clients, as well as a top 5 independent investment broker dealer as well, if we're looking at kind of the 2 sides of things there. But a little bit specific to me, I'm not going to spend too much time on that, but I have been in the financial planning industry with Northwestern Mutual for about 3 years. I mentioned where, of course, my office is from, but if anyone watching this is from New Jersey, I am also from New Jersey. But of course, I've built a home here in upstate New York. And if anyone needs any additional help in regards to anything, my information is also here as well. I prefer reaching out to my cell phone and my email. My office line, it normally immediately goes to voicemail. So if anyone needs anything, please utilize cell phone and email. If you do call the office line, I will get back to you, but probably somewhere between 1 to 3 business days. So scrolling down a little bit, enough at looking at that picture of myself. When we're talking about building a plan, there's a saying where we need to build a really strong foundation before we can start to build up. And what I mean by that is initially, whether you come out of college with a new job, whether you start your own business, you're starting from the ground up, right? And
Mhm.
honestly, goal for a lot of people is to build assets.
Right.
Initially, people's mind goes to 401k, 403b, right? So retirement vehicles that your company offers you, and that's where we're going to grow some assets for ourselves, which
Okay.
is a really great place to grow assets, but we haven't actually thought about that foundation first, right?
Right.
We're immediately starting to grow. So we need to think about some foundational pieces that protect the growth of whether that be our retirement account, whether that be additional accounts that we have. So when we're talking about a solid foundation, this is where we start to talk a little bit about risk management and really what that looks like. So I'm sure that you can see here at the bottom of the pyramid, we have a couple of examples of really what risk management looks like to clients. Sometimes it's life insurance, like we've mentioned. Sometimes it's looking at disability insurance, right? God forbid you were to be out of work. We want to protect your paycheck, right?
Right.
Majority of the time, we have health insurance to protect those very large costs that being in the hospital or things in that regard can account for. But
Mhm.
not protecting your paycheck, right? So a lot of the time we want to make sure that our paycheck is also being protected initially as well. So if you ever were to be out of work, we don't necessarily have to worry about where are we going to pull money from to pay
Mhm.
that. Ultimately, number one, we don't want that to be debt, right? Going into debt if we need money. We don't want to have to pull from assets that are for different goals, right? So if we
Right.
think about retirement, but we're out of work when we're 35, we don't want to pull out of our retirement account and utilize that money because you've already spent years building that up. So
Right.
that's a really big foundational piece that we want to make sure clients are aware of as well. There is also some additional insurance pieces in there as well in regards to when you purchase a home, in regards to building a business and things in that regard. But really the three main areas we'll look at with our clients for building a foundation is disability insurance, life insurance, and then long-term care. But also dependent on how old you are, what your
Right.
goals look like, things like that. And once we really have that solid foundation, that's when we can start the growth process, right? Or even we already started the growth process. Let's take a step back,
Right.
build the foundation, and then go back.
Okay.
So that's huge as well. But
But not to cut you off, but a lot of
go
jobs
ahead.
don't even offer
I know.
um the 401k or even the disability. I
Yeah,
mean, so some people aren't even establishing that foundation for many, many years, if at all, which is
exactly.
unfortunate.
Yeah. And it even comes from an education standpoint too, right? If your HR person is not actually bringing it up to you, it's probably not something that you're going to think about until
Right.
it actually happens.
True. And by
Right?
then,
So
it's kind of too late.
exactly. And that's why I have a job
Right.
to to make sure that I'm educating those on things that their HR department's not educating them on. Or I work with a ton of business owners as well who don't have those benefits through work. What do we actually do to set those up for
Right.
yourself? Um,
Hmm.
and a misconception too around financial advising is that you need a lot of money in order to meet with a financial advisor.
Hmm.
It's a stigma, right?
Right.
I am a firm believer in that every single person that I meet with deserves a financial plan. Even if it's a, hey, let's start really small. Let's get you a small life insurance policy. Let's start saving a little bit into your savings account, but let's be super efficient with that and make sure that it's
Right.
actually in the right vehicle for you. So
Absolutely.
yeah. So when we're talking about savings for our clients, everyone says, Allie, where do you want me to put my money? Where do I put my money? So this document that you're looking at right now breaks it up into about 4 different areas, but just based
Hmm.
off of timeline. So if there's any goals that a client has within the next 2 years, we normally recommend having that money super liquid. So what that means is you can access it immediately if you were to need it. Um, We do want to make sure, though, that any money that our clients have in a savings account, a checking account under your mattress, we're actually getting the highest interest rate on those accounts.
Right.
Clearly, under your mattress is not an account, but this is where putting your money into what's normally called a high yield savings account is really important for a lot of our clients because they have really, really great yields right now.
Right.
So utilizing that rather than just a regular savings account, even if it gets you an additional $50 a year, that's $50
Right.
a year
That's
you didn't have before.
absolutely every dollar.
Exactly. So that's where short-term goals go, right? And we can move a little bit further, but I'm going to skip all the way over to retirement because
Okay.
second place that we normally look at with our clients is the retirement side of things. Because majority of the time, and I'm going to say majority in quotes, but if I'm meeting with a client who is on the younger side of things, they have a really long time between now and the time they retire. And I
Right.
would rather them not wake up at 65 when they're going to retire and then say, shoot, I didn't save anything.
Right.
So we always talk about what your current retirement strategy has looked like or what we want it to look like, right? So taking into account, when do you actually want to retire? Are you on track for that with what you're currently doing?
Mhm.
And I utilize a software as well. Monica's aware of this.
I
That that shows you how you're tracking for retirement based off of where your dollars are going, any additional benefits, like I said, that you're getting through work, but we want to make sure that we're maximizing those. And if we don't have those, actually putting them in place.
Right.
Once we sort of have those two areas going for us, so today and then the future, we'll kind of look in the midterm for a lot of our clients, right? And this is where we'll start talking about utilizing the market for investment returns. This is where we start talking about purchasing property for a lot of our clients because property is an asset at the end of
Right.
the day. So that's super important. And then also talking a little bit about permanent life insurance. So later, I will talk a little bit about the difference between term and permanent insurance, but it's on this savings sheet because we can use it as a savings vehicle for a lot of our clients as well. Okay.
Mhm.
Perfect. So I know I talked about retirement a little bit, but there's about 3 areas that we want clients to save into for retirement. And you can see here, it's base income, investments with distribution flexibility, and some sort of cash reserve. Now, when people think about saving for retirement, their mind immediately goes to, okay, I'll save into a retirement specific account, right? Which knocks off one of these buckets that we want you to save into. But what a lot of our clients won't think about is, what about some sort of consistent income that's coming in the door in retirement? We need to make sure we have that, right? Because God forbid the market's down and we're in retirement, we're not going to want to pull out of those market correlated assets, right? Because end of the day, we're going to sell at a loss. So we also need what's called a cash reserve. A cash reserve is super safe bucket of money that's still gaining you interest and dividends on the account. So for example, in this case, you can see there's a life insurance bucket there. Like I mentioned earlier, right? We can utilize life insurance to help clients grow cash in a separate bucket that's not just savings account and retirement account. So a lot of these plans will work together really, really well because we have base income coming in the door. Think about that as like pension, social security, an annuity, things like that, that we don't have to worry whether or not it's going to come in because they're just going to give you a check monthly or direct deposit it. Exactly. But keep in mind, not everyone has a pension. Right. And actually, not everyone has Social Security either.
Especially people who are not working your traditional job. So anyone who's doing cash, like off the books, like you're just, which I don't really think people are really realizing, when you're young, you're not thinking when you're down the road and all of a sudden you wake up and you're 65, So that's definitely something to look into when you are young and you're picking a job, it's going to affect you tremendously because your bucket over there is going to be pretty much empty, and now you're struggling and you're going to have to work. So there's never any retirement.
Yeah, exactly. But yeah, you basically reap the reward today of not paying as many taxes.
Yeah.
But then retirement, you doesn't have any Social Security coming in the door.
Right, which is horrible.
Exactly. And Social Security, we could do an entire another hour conversation
Right.
about what the future of that's going to look like and things in
Mhm.
that regard. But majority of the time when I'm running plans for my clients, I always run it super conservatively, right? So
Okay.
if you're retiring in the next let's start at the beginning. If you're retiring in 40 years, I'm probably not going to show any Social Security in your plan. If you're retiring in 20 years, I'll probably show anywhere from like 50 to 75% of the Social Security that we estimate you get. If you're
Okay.
retiring in anywhere from 5-ish to 10-ish years, then we'll probably show 100% of the Social Security that we think you're going to get.
Interesting.
So making sure that we're not overestimating the amount that you're getting. And I would much rather clients have more money in retirement than not enough.
Absolutely.
Right?
Absolutely.
But yeah, so this trio of retirement vehicles really allows clients to not only have different buckets of money to
Mhm.
pull from when different things happen, but it also provides you with another sense of security, right?
Right.
There's always the analogy of don't put all of your eggs in one basket.
Right.
So we want to make sure that not all of our dollars are just in one savings vehicle.
Makes sense.
Right. Perfect. So scrolling down a little bit, we talked a little bit about defensive risk protection side of things, but here's a little bit more of a breakdown in regards to it. So first thing that I normally look at with clients is what their emergency fund looks like. Keeping it super simple, normally recommend clients to have anywhere from 3 to 6 months of expenses saved up. Now, that's fixed expenses. So think
Right.
of mortgage, think of rent, think of car insurance, groceries I even include in there because even though it's not fixed, we still want to make sure that you can eat
Right.
if something were to happen. So
Right.
having anywhere from 3 to 6 months of expenses saved up is really, really big. But one thing that I think Monica has brought up to me before, but it's that people are really, really good at paying their bills, but people are not very good at actually saving.
Right.
So there's a lot of different strategies that I'll utilize with clients to actually build your emergency fund. Now, some clients just need to be told what to do.
Right.
And I can say, hey, you need to save this amount monthly in order to reach this goal. And some of them will just do it. Some of them need me to tell their employer to set up automatic contributions to a high yield savings account that they just forget about. Right.
Right.
And they need that sometimes to just be out of sight, out of mind, but they know they at least have that savings up.
Mhm.
So it's a lot of different strategies there, but that's rule of thumb always. Another thing as well is, are we effectively paying down our debt? So when I'm talking about debt with clients, normally there's a lot of emphasis on paying down higher interest rate debt initially.
Mhm.
That doesn't mean that we should not pay down our other debt at the same time as well.
Right.
But there's a fine line between making sure that we're paying down our debt efficiently, but also saving at the same time. So a lot of clients will think it's one or the other, right? Where it's like, okay, I'll pay down my debt first and then I'll start saving for retirement. But if you think about it, it might take you 10 years to pay down that debt. And that's
Mhm.
10 years that you did not have saving into some sort of
Right.
account. So there needs to be some sort of fine line between, okay, I'm paying down the debt to the best of my ability, high
Mhm.
interest debt first, right? So we're not gaining a large amount of interest on it. But I'm also saving at the same time. So, like I said, different for everyone, but really important. And
Would you
then,
suggest for someone to like get a part-time job to try to establish an emergency fund? Because like, 3 to 6 months, once the 3 to 6 months of the expenses are in the fund, do you stop, or do you keep pouring in whatever that you were initially trying to put in to get to that point?
Great question. So if first question that you asked, I'll go over that and really quick. It is not in my expertise to recommend someone go get an additional job, but sometimes I do have to be super honest with clients and say, hey, we're bringing in $5,000 a month and your expenses are about $4,500. You have about $500 a month to work with.
Right.
I'm not going to tell you to save every single penny that you have, because if you want to go out to eat with the family, like go out to eat with the family, you know what I mean? But there is also sometimes a sense of discipline in regards to budgeting as well, that we have to take a step back and say, okay, if are you actually spending $4,500 a month on things that are necessary?
Absolutely.
Exactly. So that's first question. And then second question that you asked about continuing to put dollars towards like an emergency fund if you already have 3 to 6 months. I wouldn't recommend you fund it as much as you were in order to get there.
Okay.
But it really does not hurt to continue to put some dollars towards there.
Okay.
That doesn't mean your full surplus though, right? Of how much you have left over at the end of the month.
Right.
But when it comes to diversifying our savings as well, sometimes I'll say, okay, Monica, you now have 6 months of expenses in your savings account, and we were putting $500 a month away into that. Maybe let's break that down to only doing 100, 200 into there, and we'll take that additional 300, 400 and allocate it towards another savings vehicle for you so we can diversify.
Okay.
So yeah, but keep in mind, don't want clients to stop saving into there, because it is an emergency fund for a reason, right? And if an emergency does come up and we liquidate some or all of that account, I at least want you still to be in the habit of putting money in there.
Absolutely.
Yeah. Perfect. So this is another thing that we also went over. What happens if we're hurt, sick, or injured? How do we make sure that the bills are actually paid? So this is what I was going over earlier as well, but this is where a lot of the time that income protection piece of things comes into play. We normally want 3 to 6 months worth of expenses because if we're out normally for a 3-month period of time, that's before any sort of long-term disability were to kick in for a lot of clients. There's normally some companies will offer short-term disability for clients, but sometimes you have to pay additional for it and things like that. And it's normally more expensive to have short-term disability than it is long-term disability, because likelihood of you being out for a short period of time is a lot higher than the likelihood of you being out for a long period of time.
Okay.
But if we really do think about it, if you're out for 3 months and you have a 3 to 6 month emergency fund, you're going to be okay.
Right.
If you're out for 3+ months and you have a 3 to 6 month emergency fund, you're probably not going to be okay.
Right.
Right. And this is where I was going to earlier. If we do have assets to our name, we don't want to have to pull out of those assets just because we're hurt, sick, or injured. We want our income to continue to come in the door. So this is where I'll talk about income protection with clients and making sure that 100% of their actual paycheck is covered. Does that make sense?
Yeah, definitely 100%, because I know some companies don't give 100%. Like it's a percentage, but it's like, even a percentage is not going to keep you above water. You're going to be every month, you're going to be a little bit further and further behind. So really, what is it doing?
Yeah, there's a ratio out there, and this is very specific to the kind of person, but it is that 60% of your income should be going towards expenses, 20% should be going towards savings, and then that last 20% is discretionary. So do whatever the heck you want with.
Oh, okay.
This is when I'm meeting with younger clients, I'll go over that a lot because it's a lot easier to establish that early on when you're just starting to take on more expenses and things. But it's a very workable goal, and that's always the goal to actually get there. So and the percentage that you were talking about, Monica, is normally anywhere from 50 to 60% of someone's income. And if we're following that like foolproof 60-20-20 strategy, and you only have you have 60% of your income coming in the door, sure, you can pay your bills, but however long you're out, you're not going to be saving into your retirement account. That's going to add years on your actual working career if you can go back to work at the end of the day.
Right.
Yeah, so there's a lot of things to make sure that we're thinking about here, and a lot of I hesitate to use the word morbid, but like morbid negative conversations that we have to have. But
Yes.
once we have these conversations, if anything bad does happen, we're not going to have those crazy morbid conversations anymore because we know
Right.
that you're going to at least be okay financially.
True.
But so that's a little bit on the income protection side of things.
Okay.
Then when we're talking about life insurance, it's, do we need it? What kinds are out there and how much do I actually need? Those are normally the three questions that I'll go over with clients. The first one, do we need it? I'm a firm believer in that everyone needs life insurance. Everyone.
Absolutely.
And even if you don't have a family right now, you don't have any children right now, you don't have any large amounts of debt, right? You haven't purchased a home yet. If you know that those are things you want in the future, get life insurance.
Absolutely.
Right? Because if those are things you want in the future, you might not be able to get approved for that, for some sort of life insurance in the future as well. So what kinds are out there? I'll talk about that now. So there's multiple kinds of life insurance, but there's two like umbrellas that we can put different kinds of life insurance under. So the first kind is called term. So I want you to think about this as like renting a house, right? When you rent from a landlord, you don't necessarily own the property at the end of the day. The only thing that you really got out of it was the fact that you had a place to lay your head down on your pillow at night, that you had a roof over your head, like a place to cook dinner, and those sorts of things. Very similar to term insurance, where you're paying monthly, same exact way you're sort of paying with rent for a policy, and that policy is going to cover you for a specific period of time. Same things like a lease is a year. A term life insurance policy could be 10 years, 20 years. Certain ones last until you're age 80. And it's really dependent on the client and what fits them best. So not everyone will be approved or is actually eligible for certain types of life insurance as well. So that's something important to note, right? If you're sitting here saying, great, I want a policy that lasts me until I'm age 80, but an insurance company won't approve you for that, that's also something important to notice. And that's why I think it's super important to have these conversations with financial advisor. And big reason too why I recommend clients to do their life insurance planning with a financial advisor is the inevitable happens, right? When that day actually comes, someone in your family is going to come into a large lump sum of money, right? What they do with that is super important. And I think the clients that I'm servicing would want to make sure that their kids know what to do and they don't just blow it. Do you know what I mean?
Absolutely.
Yeah, so that it's actually going towards the right areas. We're putting it in the right vehicles if there's excess. Like, where do we actually put that money? So that's a side note, but always want to put that out there. And then the second type of life insurance that we look at with clients is called permanent insurance. So I want you to think about this like purchasing a house, right? When you actually purchase a home, you own that home at the end of the day, right? You're putting mortgage payments towards the debt, towards the mortgage, but you're going to own the home at the end of the day. There's going to be equity that builds up inside of the home. So you're going to have access to however much that home grows to, whether that be with a line of credit, whether you sell the home, those sorts of things. Very similar to the way that cash grows inside of a permanent life insurance vehicle. So we utilize permanent life insurance since it's permanent, which means it doesn't have a specific term or specific time period in which you need to pass away in order for the coverage to actually pay out. And there's also that additional benefit of having the cash associated to it as well that we can access at different points in time.
And that's only with the permanent one, not with the term.
Yes.
Okay.
But something that's really, really important that we always talk about with all of our clients that might not initially be ready for permanent insurance, but know that this is something that down the line is going to be important to them, is we'll look at locking in your insurability now with
Hmm.
some sort of term policy, because it is always cheaper than a permanent policy. But what you're actually able to do is if you do get approved for a term policy, you can convert the term
Oh,
policy over to a permanent policy at any point in time without going through medical underwriting again.
that's what I was going to ask you. Okay, so
Yeah,
that's good to know.
exactly. And that is not with every company though. So I do want
Yeah.
to put that out there too. Not every company offers permanent insurance, offers the convertibility aspect, and that's
Hmm.
why it's super important to make sure that you're aware of that. But yeah, so the permanent insurance at the end of the day, it builds the accumulated value inside of the policy. Policy lasts forever, and you can actually take loans out of the policy to
Hmm.
do things with whatever you
Good.
want. Yeah, so it's not specific for retirement. It's not specific for a certain amount of time. You can use it in retirement though, which is what we'll utilize a lot of the time. If you remember on that, I think 2 slides ago,
Yeah.
when we were looking at utilizing it in retirement,
Hmm.
it is a really great vehicle that we sometimes recommend for our clients to put some dollars in as additional savings.
Now, with permanent insurance, if someone, say 25 years old, and they purchase a permanent insurance policy, is there a certain age where they no longer have to pay anymore and they just have it, or are they paying all the time?
Yeah, so you can actually pick that. So you can pay into it. There's different ages that you can pick into how long you want to pay into it. You can pay it until age 100. You can pay
Oh,
it until age 65. You can pay it for only 20 years. You can pay it for only 10 years. And you'd still have the coverage after then. Just
hmm.
something to keep in mind though, as you pay into it less, the premium increases for the same amount of coverage,
I
right?
was going
So
to ask you.
exactly. So if you have a $500,000 policy that is $500 a month versus you have it for paying into it until you're 100, you
Hmm.
might have a $500,000 policy. If you only pay it for 10 years, it's probably going to be like $2,000 a month.
Mm.
Yeah.
Ba-
So
Basically, whatever you're picking, you're still going to pay the same amount. Is that what I kind of hear you saying?
technically, no.
Okay.
Technically, no, but idea, yes,
Okay.
if that makes sense. Um, but yes, the more amount of money that you put into it, the more that it's going to grow. So I normally don't recommend clients go the only pay into it for 10 years route because there's not going to be that much cash in it at the end of the day. If you're
Yeah.
not funding it continuously, right? If you only saved into that emergency fund until you had that 6 months, it's not going to have as much money if you continue to actually fund it.
Okay.
So that's why I recommend clients make sort of those consistent savings into something like that. But perfect. Okay.
Well, what do you say to someone who's young and they're thinking like, oh, I have a lot of time to think about life insurance and financial planning. I'll get to that tomorrow. Like, what do you say to those clients or potential clients who are saying that? Because I think me, myself, I've been there and that wasn't at the top of my priority. So what do you
Yeah.
say to get them to understand that now is the right time as opposed to later down the road?
Yeah. So I meet with clients anywhere from just graduated college to 20, 30 years into retirement, right? So
Mhm.
I'm meeting with clients all across the board. And what I actually do is utilize my clients who are in retirement now and talk to them about things that they wish they did. I'll take a look at their plan, right? And see
Right.
the gaps that are in there that um, I was trying to think of a year, 40 years ago, that I was not a financial advisor. Do you know what I mean?
Right.
So I will always learn from these generations that are in retirement and what they did wrong and make sure that my younger clients are very much aware of that. And just specific example, I have some clients who had that same exact mindset finally sat down with me. They're about 32 now, have a
Mhm.
house, baby on the way, and they're finally starting to think about these things, but
Right.
it's at a point where it's almost too late, but they're
Mhm.
only 32. You know what I mean? Like
Yeah.
that's where it's like okay, you're gonna have to save a lot of money. And this doesn't come from a scaring tactic or things
Right.
in that
Right.
regard. I have to be honest with clients a lot of the time too, right? Where you're gonna have to be super disciplined if you do want to retire by the time you're 65.
True.
Um, unless you're okay with working a little bit longer, and saving a little bit less, those sorts of things. But I make sure that I'm utilizing, like I said, the mistakes of generations in retirement right now and making sure that I'm educating my younger clients on that. So they're aware that if they don't start early, there's always a cost of waiting, right? It's opportunity cost. If
Right.
I wait to do this, and I actually have a really, really great example of this. Now that you reminded me, I
Oh,
have
good.
a sample plan, and I don't want to make anyone dizzy by scrolling through this. But here it is. So this page right here just is
Oh,
the
wow.
importance of investing early. So this is someone who starts at age 25, someone who starts at age 35, someone who starts at 45 and 55, and their goal is to make $1 million. Not even make, but have an asset
Right.
worth $1 million by the time that they're 65.
Oh,
So
wow.
if you look here, if someone starts saving at 25 and they save about $381 a month, by the time that they're 65, they're going to have $1 million. If you start at 35, you're going to have to save about $820 a month
Mm.
in order to have $1 million by 65. If you start at 45 in order to have $1 million, it's about $1,900 a month.
Wow.
Yeah. If you start at 55, so in order to save $1 million in 10 years, you're going to need to save about
Oh my God.
$5,800 a month.
All of your income.
Exactly. Um, and this is where we take into account also market gains as well. I'm sure you can see the
Yeah.
yellow. The yellow is
Hmm.
the total growth. Like if you and honestly, showing clients this page, if they
Right.
put away 180 grand, you're gonna have $1 million by the time you're 65. Do you know what I mean?
That's
Versus
great.
having to put away 700 grand and you only get $300,000 of gains on that account. So
That's
this is,
amazing.
yeah, this, I cannot believe I didn't think about this when you
Yeah.
asked the question. But this is really, really important to make sure that clients are aware that starting early and doing even a little bit is going to be huge in the end.
It's better to do a little bit than nothing at all.
Exactly.
Yeah,
Exactly.
absolutely. I agree. I just wish that more people would just understand, especially if they can't do the emergency fund, if they're struggling with doing that, if they're struggling with having the different types of buckets. But I really feel that the most important thing is that every single person should have life insurance so that
And
people aren't, trying to gather people and do Cash App or do like a GoFundMe or all of those,
exactly.
because it's just no one wants to think about all of that during that time, period to just figure out how we're going to bury, this loved one. You want to have all of that taken care of so people in your family don't have to just really, grieve and try to financially put things together for them. So that would be my
Exactly.
wish, that hopefully everyone who sees this will just really understand the importance of it. And I thank you for sharing that with us tonight. But before I let you go, could you just
Yeah,
please tell us how can we contact you? You said the best way to contact you is by cell in your email. I just want
of
to put that up
course.
time.
Yes. So it's on the screen right now if you can see it. I'll read it off
Yes.
though. My cell phone number is 609-661-1063. And then email is first name dot last name at nm.com. So nancymary.com.
Awesome.
Yeah. And I'm more than happy to chat with anyone that even has questions, right? There's never any ties with a conversation. That's something too that I should have mentioned.
Right.
Conversations are free with me. And I'm always here for the client to make sure that they are educated and that they're doing the best things for them and their family.
Well, that's awesome. And I thank you so much, Allie, for
Of
joining
course.
us this evening and sharing these wonderful jewels with us.
Of course.
Well, thank you everyone for watching, and everyone have a great night.
Bye.
Bye-bye.